Welcome to The Explainer. Today, we're breaking down a powerful method for understanding the market's true intraday direction. It's all about identifying what we call the drive, that underlying force that can make the difference between a winning trade and a really frustrating loss. So, here's how we're going to break it all down. First, we'll talk about a super common problem that I know drives traders crazy. Then, we'll get into this idea of market drive and the tool you need to measure it. We'll walk through some real-world examples, both up and down, and then wrap up with how you can actually build this edge into your own trading. All right, let's kick things off with a feeling I'm sure every single one of you knows all too well. It's that moment you're so sure you've got the direction right, but then the market makes a quick move and proves you wrong. And, well, poorer. I mean, seriously, how many times has this happened to you? You see the trend, you get in, but then some little dip, a bit of noise, and bam, you're stopped out. And the worst part, you have to sit there and watch the market do exactly what you thought it was going to do, just without you. It is absolutely infuriating. So what's the fix? How do we stop getting shaken out of perfectly good trades? Well, the argument here is that the answer isn't some new, complicated entry formula. It's about taking a step back and getting a real feel for the bigger picture, understanding the market's true intention for the day. And that's the whole philosophy in a nutshell. It's about grasping the market's underlying strength, what we are calling its drive. When you understand that, you get something way more valuable than an entry signal. You get conviction, the kind of conviction that lets you hold on through the noise, because you know where the market is really headed. Okay, so how do we actually measure this drive? Well, the main tool we're going to use for this is the put-call ratio, or PCR for short. Let's dig into what it is, and more importantly, what the numbers are actually telling us. Think of these numbers as your cheat sheet for the market's mood. Once you see that PCR value cross 120, that's your signal. The bulls are in charge. It's a green light to start looking for opportunities to buy on dips. If it gets all the way up past 140, that's extreme conviction. The market is probably just going to keep grinding to new highs. And on the flip side, if you see it drop below 0.60, that's a big red flag. It means the bears are in control, and you should be thinking, sell on rise. Now, this next point is huge, so listen up. The PCR is not a magic trading signal. It doesn't tell you exactly when to buy or sell. Think of it like a compass. It tells you which way the wind is blowing, which direction you should be facing. It gives you the conviction to know whether you should even be looking for long trades in the first place. You still have to use your own strategy to pick your spot. Okay, enough theory. Let's get into the good stuff and see how this actually works on a real chart. We're going to look at some examples where a high PCR gave a crystal clear signal that the market was headed up and gave traders the confidence to just ride the wave. First up, we're looking at the banknifty. On this day, even though the price chart looked a little choppy at times, the underlying strength was just incredible. So check out the data. Right from the get-go, the PCR was screaming bullish. It was way above that 1.20 level. And notice, even when the market was moving sideways, the PCR stayed high. That's your clue that the big players, the institutions, they're likely accumulating positions, not getting out. And here is where it all clicks. You see that dip on the chart? Without the PCR dare, you might panic and sell, right? But with that high PCR reading, you can see that dip for what it really is, a buying opportunity in a strong market. And sure enough, the market confirmed it by just pushing to one new high after another. All right, let's look at another one, this time with the Nifty index, just to prove this isn't a one-off. Let's see that pattern again. Now, this one is really cool because it shows you how sentiment can completely flip. The market opened looking pretty weak, but if you were watching the PCR, you would have seen it start climbing right away. And once it broke through that key 1.20 level, that was the signal that the entire mood of the day had changed. The bulls were taking over. And what happened next? Exactly what you'd expect. The price action followed the sentiment. It leveled out for a bit and then just started this relentless climb, hitting new highs. Once again, that rising PCR gave you the confidence to know that any small pullback was just a chance to get on board. Okay, so we've seen what happens when the bulls are in charge. But what about the other side of the coin? How does the PCR act as a warning system and tell us when to stay away or even look for shorts? So for this, we'll go back to the banknifty, but on a day where the market was just ugly. A day where trying to buy the dip would have been a very painful mistake. And the data tells the whole story. The PCR was pinned down in that extreme negative zone basically all day long.
There was no recovery, no bounce, no hint that the bulls were even thinking about showing up. This is a 5-alarm fire drill telling you the sellers have absolute control.
So what did the price do? It did exactly what the PCR told us it was going to do. It just kept falling, hitting a new low, pausing for a bit, and then hitting another new low. This is a perfect example of how the PCR keeps you from trying to be a hero and catch a falling knife. It helps you stay on the right side of the trend. All right, so we've seen the theory, we've seen the live examples. What's the bottom line here? How do you actually take this and use it to make a real difference in your own trading? Let's boil it all down. First, use the PCR to get a read on the market's bias for the day, its drive. If that PCR is high, over 1.20, that gives you the confidence to look for buy-the-dip setups. If it's low or going nowhere, that's your cue to be careful, or even look for opportunities to sell the rise. And, most importantly, remember, this is a tool for conviction. It's not the whole strategy. You combine this analysis with your own trading system to give it a massive boost. And that really brings us to the final big question, doesn't it? What's really going to make you a better trader in the long run? Is it endlessly chasing that perfect, magical entry signal? Or is it having the deep, data-backed confidence to actually hold on to a good trade and let it play out to its full potential? I'll let you think about that one.